Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. It is getting spicy out there in the local retail sector. We find ourselves in a world that is very far removed from the rising tide that lifts all boats. That classic description for an environment that allows the weak to survive while the strong quietly pull ahead. In the current state of play, the weak are drowning, and the strong are pretty happy to just be treading water right now. It won't be news to you that stocks in the retail sector have had a terrible 12 months. I'll just pick out a few names here. You know them already. Foschini Group down 40%, Truworths down 31%, Pepkor up just 2%. See what I mean about drowning versus treading water? There are a few reasons why this is happening, but they all come down to one thing at the end of the day. In the broken names, there is part of the business that is dragging the rest down. It's usually an offshore business, with Truworths as the exception right now that proves the rule. And you can refer back to a recent episode of Supernatural Stocks where I explained my distaste for the Mr. Price NKD deal, a transaction that flies in the face of market sentiment and most definitions of common sense. Now, the recent announcements in this sector have focused on the performance in the final quarter of 2025. It was a tough period because the base for comparison, that's the fourth quarter of 2024, was boosted by South Africans taking their retirement savings and spending them on consumer products thanks to the two-pot withdrawal system. I try hard not to think about pensions going into new TVs. I try even harder not to think of pensions going into online betting. Aside from reading company announcements in detail, it is always worth checking out the Stats SA retail trade sales data. The latest available stats deal with November 2025, a month which features the Black Friday trading rush. Before I dive into what we can learn from this report, I do want to highlight that the theme across the retail releases from companies has been that Black Friday was really strong. The word record has come up a few times. Management teams are talking about a pull forward of festive season trading into November. I think there are two reasons for this. The first is that South Africans are bargain hunters of note, and for better or worse, Black Friday is perceived as offering the best deals. On many occasions, I've had discussions with retail execs around price sensitivity of South African consumers, one of the features that makes it a tough market. The other reason is that online shopping adoption is going through the roof, which means festive shopping is being done on smartphones rather than by walking from store to store. Even if you're sitting in the office on Black Friday, you can still spend some time locking in those deals and getting them delivered to you. Long gone are the days that I remember from my childhood of being taken to multiple chaotic shopping centers trying to find those last few items. So when we consider this Stats SA report, just remember that the Black Friday numbers are in here. Naturally, Black Friday is also in the base period in November 2024. But if there's a particular shopping experience that is getting bigger and bigger every single year, then it stands to reason that November's year-on-year performance would be flattered versus a month like December. Before we dig into the detail, we need to actually understand the way in which Stats SA reports. They are not going to tell you how a specific company is performing. Instead, they will aggregate all the data that they get in the market and they will use it to show how a particular sector is performing. Retailers use this data along with category level information from the likes of Nielsen and GfK to figure out how they are performing versus the market. Achieving growth in retail is all about managing each and every category and figuring out how to win and where you should even be playing in the first place. The biggest category is general dealers, which includes the large grocery chains. That's why this category is nearly half of the market. The next largest is called textiles, clothing, footwear and leather goods, with a mid-teens percentage contribution to the retail market. You hopefully get the idea in terms of how the reporting works. Another important point to raise is that Stats SA distinguishes between nominal and real growth. This allows users of the report to figure out the changes in volumes as well as in total sales. They do this based on 2019 constant prices. Now, the two-pot period stands out clearly on this basis. Using constant prices, total South African retail sales were up 8% year-on-year in November 2024. So that's an 8% increase in volumes. That is immense. And this is the base that retailers were up against in November 2025. So what were the results? Well, at constant prices, November 2025 delivered year-on-year growth of 3.5%. So that's 3.5% growth in volumes across the board. It's an acceleration, by the way, from each of September and October, up 3% year-on-year, but way off the growth seen in the start of 2025, where there was a very weak base at the beginning of 2024. It is important to keep these base effects in mind at all times, but the overall story here is that November managed volumes growth of 3.5% against a very tough base. The winning segment here is clear. It's pharmaceuticals and medical goods, cosmetics and toiletries, i.e. pharmacy and health and beauty, achieved growth of 10.1%. That is a massive increase in volumes. So you would expect the likes of Clicks to be cleaning up at the moment. Alas, Clicks had system issues that hurt their stock and thus their sales in the latest period, so they couldn't actually take advantage of this trend. Of course, we wonder who did take advantage. Competition in this space is only going to increase over time because health and beauty is a highly lucrative category with great margins, long shelf life, and tons of private label opportunities for the players in the space. Special mention must also go to household furniture, appliances, and equipment, with an 8.9% increase. This helps explain why Lewis put out some encouraging numbers recently, although I'll explain a very important nuance later. This retail segment has actually been doing very well. If you can believe it, November's growth of 8.9% was considerably slower than 11.4% in September and 11.3% in October. Again, big base effect, not necessarily a slowdown because these are all year-on-year numbers, but interesting nonetheless and a really strong performance over 3 months. What about the beleaguered clothing retailers? Well, textiles, clothing, footwear and leather goods could only manage a 2.3% increase. An incredibly weak outcome that they just keep trying to blame on online betting. Yes, that is definitely a concern, but it doesn't explain why other categories have done so well, like furniture for example, and other areas like health and beauty. Perhaps people are just buying imported clothes from China instead of shopping at local stores. Perhaps people are just tired of fast fashion and buying low quality clothes at inflated prices. Maybe they've realized they just don't need to buy clothes as often. I don't know what the reason is, but I will tell you that convenient scapegoats should always be treated with suspicion. Another category worth mentioning is hardware, paint and glass, with a 3.9% increase in November. I must say that's a surprise for me when you consider how poor the recent quarter at Cashbuild was. What about inflation? The other important way to view the data is through the lens of current prices, in other words with the impact of inflation included in the numbers. Mild inflation is actually a free ride for revenue growth at retailers because consumers accept higher prices and are willing to pay them because they actually have no choice. However, this is only a benefit for profitability if the prices in the store are increasing by a higher rate than the costs to run the business, something that is rare in South Africa where costs like energy, municipal charges and security run rampant. Mild inflation at least gives you some protection against these things. But when inflation is very low, which gets the SARB really excited, retailers become sitting ducks who rely on volumes for growth. South African consumers are so used to being crushed by prices and other pressures that we just don't seem to fill up our baskets just because prices are slightly less onerous. We tend to be a conservative bunch. We'll look for the bargains, but we might not buy more just because stuff seems to be cheaper. And if you believe the clothing retailers, when we do have extra money, we go and use it on online betting anyway, instead of putting more in our trolleys and baskets. As we apply this lens now that includes inflation, we may as well then start with clothing. Inflation did not help them much here because sales were up just 2.7% versus constant price sales up 2.3%. That doesn't even touch sides in the context of operating cost inflation, which is why we are now seeing such divergence in the share prices in the sector. The tide is not lifting all boats. If anything, the tide has gone out and a few names are swimming naked. The pharmacy and health and beauty retailers, on the other hand, they are loving life. Their category grew 14% year on year, including inflation, versus 10.1% without it. You have to really mess it up to not make money in that environment. It's little wonder then that all the grocery retailers continuously try and get a bigger slice of market share from players like Clicks and Dis-Chem. Now, prepare yourself for perhaps the most interesting number of all and the biggest surprise. Remember the furniture and appliances segment with that 8.9% increase at constant prices? At current prices, that segment is up just 4.1%. This tells me there has been considerable deflation in that space, which is why Lewis's sales growth isn't nearly as high as the growth in volumes suggested by Stats SA. Hardware, paint and glass, let's finish up there. That's up 4.4%, just 50 basis points more than the growth at constant prices. I still have no real explanation for the negative surprise of Cashbuild's fourth quarter sales. Something seems to have gone quite badly wrong there. In summary, and as we look ahead, it's clear to me that the two-pot impact is not over yet. It looks like it leaked into the start of 2025 if I look at the monthly sales at constant prices. Yes, there was a weak base at the start of 2024, and I understand that. That's a mitigating factor when I see these numbers. But there seems to have been some two-pot money left as people entered 2025. January 2025 sales at constant prices, so that's volumes, they were up 6.8%, and February was good for 4.6%. Then it fell off a cliff, up just 1.7% for March 2025. Now we know that the 2025 exit velocity was weak. We don't have the Stats SA data for that month yet, but retailers generally had a bearish tone on December versus November. If you combine that with the geopolitical mess in 2026 and what this usually means for consumer confidence, I'm not overly bullish on retail sales for the first quarter of this year. I suspect it will be several months until we start seeing better results from local retailers. Doesn't mean that individual retailers can't do well, of course. If I may borrow from the fantasy goat J.R.R. Tolkien and his character Faramir, it's time for retailers to show their quality. They don't need to resist the wren like in the story, they just need to resist the temptation to do crazy things instead of getting the basics right in a tough environment. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.